Adobe is set to release its third quarter fiscal 2025 results on September 11th. The stock has dropped over 21% year to date, hurt by rising AI competition, slow progress in monetizing new tools, and cautious guidance. Some analysts are hopeful, citing steady demand for Adobe's creative tools and potential growth from tiered pricing and new products like video and 3D. Meanwhile, others stay cautious, noting slow gains from Adobe's own AI launches. Overall, Wall Street remains cautiously optimistic about the stock ahead of Q3 earnings. After that, we'll dive into how Google could hit a $4 trillion market cap sooner than many expect, and why the broader tech sector continues to show strong momentum and resilience. Wall Street analysts expect Adobe to report earnings of $5.18 per share for the third quarter of fiscal 2025, up 11.4% from the year-ago quarter. Meanwhile, analysts project Q3 revenues at $5.91 billion. This marks a year-over-year increase of over 9%. Investors will look to the Q3 results for signs that Adobe can speed up AI monetization and rebuild confidence. Ahead of the Q3 print, RBC Capital analyst Matthew Swanson kept an outperform rating and a $480 price target on Adobe. He said the creative tools market has become more crowded with new AI-driven platforms, but Adobe is adapting by adding more choice through Firefly and improving its mobile trends. Swanson sees the main opportunity for Adobe in generative editing rather than content creation. He also points to tiered pricing and advanced tools like video and 3D as key drivers of future Gen AI growth. According to Main Street data, Adobe's total digital media ARR rose to $18.09 billion in Q2 fiscal year 2025, up 12.1% year over year, driven by strong demand for AI-powered tools like Firefly. Meanwhile, Milius research analyst Ben Reitzes downgraded the stock to sell with a $310 price target, implying an 11% downside from current levels. Reitzes argues that investors may find better opportunities in infrastructure winners such as Microsoft and Oracle. Turning to Wall Street, analysts have a moderate buy consensus rating on Adobe stock based on 19 buys, 6 holds, and 3 sells assigned in the past 3 months. Furthermore, the average price target of $480.88 per share implies 37.99% upside potential. Adobe generates revenue primarily through subscription-based services. The digital media segment, which includes Creative Cloud and Document Cloud, constitutes the bulk of the company's revenue, with customers paying recurring fees for access to software and services. Adobe's transition to a subscription model has led to a steady increase in annualized recurring revenue. The digital experience segment contributes additional revenue through its suite of marketing and analytics solutions, which businesses purchase to enhance their digital marketing efforts. Furthermore, Adobe establishes strategic partnerships with various enterprises and technology companies, enhancing its market reach and driving sales through integrated solutions. The company's focus on innovation and expansion into new markets, such as artificial intelligence and machine learning, also plays a significant role in its revenue growth. Recently, other companies have started offering products that challenge Adobe, often at lower prices and sometimes with superior quality. In addition, AI poses a significant threat to their core business. However, I believe Adobe's ecosystem can withstand this AI-driven disruption if the company takes the right steps. In that case, the stock appears undervalued. I've placed a small bet on it. Let's see where it leads. Google is now my largest position, surpassing Amazon after last month's strong rally. The stock has gained nearly 20% in just 1 month and continues to trend higher. A key catalyst was a federal judge's ruling allowing Google to keep its Chrome browser, which remains a cornerstone of its business and ecosystem. Beyond the legal victory, several positive developments have further boosted momentum, most notably progress in Google's AI chips and applications. These advancements have fueled a sharp rally in the stock, pushing its valuation close to the $3 trillion mark. Looking ahead, consensus EPS estimates project profit growth at a compound annual rate of about 15% over the next few years. Under this trajectory, Google could surpass the $3 trillion milestone within the next year, joining NVIDIA, Microsoft, and Apple in the exclusive $3 trillion market cap club. Projections also suggest the potential for a $4 trillion valuation in roughly 4 years. When factoring in its aggressive share repurchase program and the possibility of valuation expansion, I see strong odds of Google reaching a $4 trillion market cap by around 2027. Google has demonstrated a large appetite for its own shares in recent quarters, as you can see from its cash flow statement below. The company has been spending on average around $60 billion per year on its share repurchase programs since 2021. Per its latest earnings report for Q 2025, the company has spent $59.5 billion as of buying back its own shares. On average, the company has been spending about 50% of its operating cash flow on share repurchases in recent years. In the meantime, the company currently ended with nearly $100 billion of cash and equivalents on its balance sheet for the quarter. Long-term debt is very low in comparison, at about $23 billion only. Given the combination of the above earnings growth potential, the strength of its balance sheet, and also its current reasonable valuation, I feel it is reasonable to expect such buybacks to continue for the next few years. To be completely thorough, the company also pays a dividend, which can further help investors to compound. But the current payout plays a very minor role in the company's capital return compared to share buybacks. To wit, the stock's current dividend yield is about 0.36% compared to an average buyback yield of 3.16% in recent years. Based on the analysis, the table illustrates the projected impact of the share repurchase. These projections were based on few assumptions. The first assumption is that Google will keep allocating about 50% of its operating cash flow to buying back its shares. The second assumption is that its operating cash flow will grow at the same pace as its projected EPS. Finally, the third assumption is that future buybacks will be executed at a valuation of 21x, approximately the current multiple. With these assumptions, my estimates point to a market of $4 trillion somewhere between 2027 and 2028, noticeably sooner than what consensus projection suggests. The key reason is the combination of simultaneous earnings growth and reduction of share counts, especially at a discounted valuation. Since compounding is multiplicative, the combined effects would be larger than the sum of these mechanisms acting individually. As a reflection, at the consensus projected growth rate, Google profits would approximately double in 5 years. However, its operating cash flow per share would grow by almost 127% due to the reduced share count of around 11% in the next 5 years, which is larger than the sum of the growth and the share count reduction. The U.S. tech industry's $8 trillion companies gained a combined $420 billion in market cap this week, lifting their total value to $21 trillion, despite a slide in NVIDIA shares. Those companies now account for roughly 36% of the S&P 500, a proportion so great by historical standards that Howard Silverblatt, senior index analyst at S&P Dow Jones Indices, told CNBC by email, "There are no comparisons." A year after losing a major antitrust case to the DOJ, Google avoided the harshest penalty as Judge Amit Mehta ruled it won't have to sell Chrome. Instead, Google must share search data with competitors. The decision allows Google to maintain its lucrative deal with Apple to remain the default search engine on iPhones, lifting Alphabet's stock by over 10% and Apple's by 3.2%. Analysts said the ruling removed a major overhang on both companies and could pave the way for deeper AI partnerships, particularly with Google's Gemini models. Mehta noted that the rise of generative AI has reshaped competition, influencing his decision. Broadcom surged 13% this week after reporting strong earnings and announcing a $10 billion contract with a new AI customer, widely believed to be OpenAI. The rally pushed Broadcom's market cap to $1.6 trillion, cementing its role as a key AI chip supplier alongside Google, Meta, and ByteDance. Analysts remain bullish, citing strong growth visibility and backlog. In contrast, NVIDIA fell 4%, its fourth straight weekly decline, though it remains the world's largest company at over $4 trillion in market cap, up 56% in the past year. Microsoft also slipped, marking 5 consecutive weeks of losses, though its stock is still up 21% year over year. That's all for today. See you in the next one.